What impact is continuing market volatility and low liquidity having on transitions, particularly equity transitions? How are you working with clients to help overcome these challenges?
Well, I think the first thing is that, volatility, we have tools as transition managers for dealing with volatility. And volatility often comes with high liquidity. And high liquidity can actually allow us to deliver lower market impact. So it's not necessarily a bad thing in a transition context. I think it partly depends on the type of transition. If you're staying within the same asset class, I think volatility and high liquidity actually can still be very efficient markets for transitioning in. Let's look at that. If volatility isn't the key problem because we have tools and hedging techniques for dealing with it, let's look at the low liquidity aspect, because that is really a primary concern for transition managers. I think if you go back to MiFID in 2007, something changed in the market, and what we've had since 2007 is a proliferation of new exchanges and dark pools. So the question for a transition manager now is, do we have access to all those forms of liquidity? Number one. Number two, do we have the technology to access all that liquidity in an efficient way? And number three, do we have the skills of traders to do that? So it's no longer a number of traders we've got, but access to liquidity, access to these venues, and the technology and skills to actually access it. And I'd say since the development of all these dark pools in particular, we've noticed that the tails of distribution in our equity portfolios are less of an issue. In fact, we're finding that we can generally trade them much more quickly than we could have done in a few years ago.
What are the main characteristics of portfolio transitions this year?
Oh, I think this year we've seen a continued move into LDI and alternative structures. Essentially clients looking to take risk off the table, looking for lower costs. And what is the transition manager's role in these particular restructurings? Well, there's three aspects that I think are crucially important. I think there's a project management, there's the hedging, and there's making sure you're getting the most from the assets that you're selling down to move into these alternative structures. This is not the traditional transition management that we remember from 10 years ago, where selling down one equity portfolio and buying another. These are much more complex restructuring, and therefore the project management element is much more important. It's essential when you're doing these types of asset reallocations that everything is nailed down completely, that everyone knows exactly who's responsible for every particular aspect. So project management is crucial. And that brings us on to hedging. We've got the legacy to the target portfolio risk to consider. Now, one of the problems in these restructurings is it's actually realizing the cash, and the liquidity events for some of the legacy assets will not coincide exactly with the dates you require to, say, move into an LDI structure or move into a property portfolio, whatever it may be. And therefore it's actually understanding these risks. And if you do have to move into cash, in order to create the cash buffer to eventually invest in these LDIs on a particular day or whatever structures you're looking for, you need to make sure you're considering the changing risk between selling down the legacy asset to the cash and looking at it. So you've got project management and you've got risk. And then, not to forget, realizing the most you possibly can from the assets you're selling down. Now that takes a lot of skill. And as a transition manager, we have portfolio traders. One of their responsibilities is to making sure they're sourcing out forms of liquidity and making sure they're getting the best prices for those assets. So I think these, though we're moving from traditionally exchange traded assets to, there's been an allocation away from them, the role of the transition manager has changed, and we're providing those same core skills of project management, risk management, and ensuring you're actually getting the best possible price and a lot of transparency around the sell down of those assets.
You say the definition of the transition management service is changing. Well, what are the drivers of this change?
The primary driver is the client's asset allocation. I mean, if you look over the last few years, clients' asset allocations have got much more complicated. So as a transition manager, what we're looking to do is actually provide them a means of changing those allocations. So we developed our products to reflect that. Take our own case, for example. We've developed a beta management business that runs along parallel to the transition management business, where we provide a beta exposure like an asset manager would. I mean, I'll give you some examples. Interim management, you want to move from a portfolio very quickly. We can actually take over that portfolio, take out some of the risk, and actually create a tracking error that's acceptable to you, that's in a passive range, and actually manage it until you find a new manager, and then you can move the securities in kind, therefore saving vast amount of money from buying and selling securities. Overlay, we've seen very significant asset allocation performance drift over the last few years, and this of course can mean that your actual asset allocation is very different to your tactical asset allocation. Well, using an overlay derivative structure, we can bring the actual asset allocation much closer to the target allocation while leaving the asset managers underlying it still with their position, and so not actually incurring that expense. Another example, refer back to what I was saying earlier, would be cash equitization, where if a fund is looking to invest in alternatives, perhaps property, perhaps private equity, then there's going to be cash calls on them, and what they want is a large cash pool to call to, because what you don't want to be doing is actually looking for cash short term, and then you go for perhaps a suboptimal way of raising it. So we can create a cash pool that's available to the fund in an optimal way, and maybe overlay it to the market so it remains invested. So that's the sort of development that's taken place. Very different to what we knew as a transition manager for even 5 years ago. Now, in regard to your question, where is this I think where did it come from? I think primarily driven by the client's demand. Their portfolios are more complex, we'd have to develop our product. But I think it's also some innovation from the industry itself. I mean, we ourselves at BNY Mellon, we've actually employed more derivatives people and people from a passive background in asset management. You employ the people, they bring innovation with them. So it's partly changing our product to reflect the demands of our client, and partly innovation because of the teams that we're developing to actually satisfy that demand.
There can be significant risks when transitioning from conventional assets into alternative structures. Can you expand on this?
Sure. I mean, one of the things to consider first of all is the correlation between the legacy portfolio and the target portfolio. And although they may not be highly correlated, if you move into cash over time, you could actually change that correlation and change that risk considerably. So that needs to be taken into consideration. And you might actually want to consider an overlay or a derivatives approach to actually move yourself from the legacy portfolio to the target portfolio. And then of course, the key thing, project management. And project management with all these types of allocations is absolutely crucial.
So how do you know that your transition manager's done a good job?
Well, first of all, information's power. And that's definitely true in transition management. And you've got a lot of information in the pre-trade and in the post-trade. So I say to my clients, invest some time, study it. Then you'll be in a really strong position to understand what's going on. The other thing I'd say, recommend would be talking to the other professionals involved, the custodian, the legacy manager, the target manager. And of course, what you want to do is understand the performance. Now, you're going to look at the T standard, the industry standard, but you also want to look at the performance of the indices relevant to that particular transition as well. And taking all those things in consideration, you'll be in a very strong position to form a view of whether or not you've actually received a good service.